A $100 trillion currency crisis has started as the surging dollar breaks foreign economies.
Macro analyst George Gammon and 3 other specialists explain why your wealth is in the crosshairs.
Watch for the specific technical signal that triggers a 24% stock market collapse. George Gammon is warning that a $100 trillion currency crisis has officially begun. And it is a problem that almost nobody is talking about.
He says it will affect the global economy and every individual viewer, focusing on 3 specific steps to explain the situation.
Looking at the DXY, which measures the dollar against other currencies, it has surged from 99 to approximately 101.3.
While many Americans only care about domestic inflation, Gammon argues that ignoring this global trend is a huge mistake.
The main thesis here is that the dollar reset isn't about the dollar losing its reserve status or crashing down.
In reality, the reset is the dollar crashing up, meaning it is appreciating so fast that it is breaking foreign economies.
Gammon notes that the conflict in the Middle East pushed oil prices toward $120 a barrel.
This spike is seen as inflationary, which changes the narrative from the Fed cutting rates to potentially raising them.
The difference between the Federal Reserve's 3.5% rate and the Bank of Japan's 1% rate creates an interest rate differential.
This gap acts as a huge tailwind for the dollar, causing it to strengthen against the yen and other currencies.
In Japan, the government is subsidizing gas to keep prices around $3 a gallon, even though the market price should be much higher.
To pay these subsidies, wholesalers must take yen to the global market to buy dollars for oil, which increases dollar demand.
Every time the yen hit 160 to the dollar, the Bank of Japan tries to defend the currency by selling dollar reserves.
However, they recently raised the overnight rate to 1% in desperation, but the yen continued to slide to 161 or even 162.
Gammon uses a historical analogy from 1200 BC, when Ramses III defeated a group called the Sea Peoples.
Although Egypt won the battle, their economy collapsed because the Sea Peoples had decimated all of Egypt's trading partners.
The strong dollar is currently taking out the United States trading partners, just like the Sea Peoples did to Egypt.
If you destroy your customers, your own economy eventually collapses because you have no one left to sell goods to.
George predicts that countries like India and South Korea will eventually run out of dollar reserves to defend their currencies.
Once they can't defend the currency, gas prices in those nations will skyrocket, effectively crushing their domestic economies.
He expects the final stage of this dollar reset to be a dramatic impact on the U.S. economy.
When the dollar finishes taking out our global customers, the resulting economic hit will be as severe as the fall of ancient empires.
The takeaway is to stop looking for a dollar crash and start preparing for a dollar surge.
George suggests that communities like Rebel Capitalist Pro can provide the intel needed to profit from these tumultuous times.
Rick Rule points back to 1975 as a vital lesson for today's gold investors. Even though we are in a long-term bull market, we can see massive volatility.
That is exactly right. In 1975, gold fell by 50% over 9 months because the political class raised interest rates to fight inflation.
So, a 50% drop does not mean the thesis is dead? It is just part of the cycle?
Exactly. Those who sold at the bottom missed a subsequent run from $100 to $850 an ounce over the next 6 years.
Rick argues that the nominal rate does not matter as much as the real interest rate. If the Treasury yields 4.5%, but inflation is 3%, you are only making 1.5%.
And with a total debt load of $155 trillion, including unfunded liabilities, can the government even afford higher rates?
That is the trap. Rick believes the only way to service this debt is to inflate away the obligation, which makes gold the ultimate insurance policy.
While gold is trading above $4,000 in this transcript, mining stocks are only being priced as if gold were at $3,400.
So, we are looking at a 19% discount just for owning the producers instead of the metal.
Precisely. Rick sees this as a major disconnect that the market will eventually have to correct.
The copper industry needs to raise $250 billion over the next decade. Much of this will come from selling gold and silver byproduct streams.
Companies like Wheaton Precious Metals and Franco-Nevada are in the catbird seat to finance these massive projects.
So they get the gold and silver upside without the operational risks of digging the mine themselves.
That is the beauty of the streaming model. Your gross is essentially your net.
Rick notes that even safe jurisdictions like British Columbia or Alberta carry risk through taxation and royalty changes.
He actually prefers a high-quality asset in a difficult jurisdiction over a mediocre asset in a safe one. The size of the prize has to justify the risk.
Rick predicts that in a credit-related crash, gold will be sold by margin clerks because it has a bid and provides immediate liquidity.
But the policy response will be to flood the market with liquidity through quantitative easing, which is extremely bullish for gold in the second leg. We are heading toward a period of major acquisitions. Rick expects to see 50% premiums paid for high-quality juniors because majors have depleted their pipelines.
Is it time to hunt for takeover targets, or just stick with the big names?
If you are willing to do the work, look for deposits that are near existing infrastructure owned by companies like Agnico Eagle.
In a structural bull market, gold leads first. Once momentum is established, the generalist investor moves into silver, causing explosive up moves.
The strategy is clear. Start with physical gold as savings, then add royalty companies, and finally focus on the best of the best producers like Agnico Eagle.
And keep some liquidity on the sidelines for when the margin clerks start selling everything.
Exactly. Maintain liquidity so you can take advantage of the crash, rather than being taken advantage of by it.
Chris Vermeulen is looking at the charts and he's seeing some pretty ugly patterns forming in the S&P 500.
He's the chief market strategist at the Technical Traders. And he's not a permabear. He's been riding this bull market, but he thinks the music is about to stop.
So he's not just guessing? He's actually looking at the data flow?
Exactly. He uses price action and cycle analysis to figure out where the big money is actually moving. And right now, it's moving toward the exits.
Chris's big thesis is that we're in a stage 3 topping phase. That's the messy, volatile part of the cycle before the big drop.
Stage 3? What comes next? A total collapse?
He calls it stage 4, which is a full-blown bear market. Based on the size of the current topping pattern, he's projecting a 24% decline.
That would take the S&P 500 down to the 4,000 level. It sounds extreme, but he says it's just a standard measured move.
Vermeulen is pointing at the VIX and the put-call ratio being at multi-year lows. Nobody is buying insurance right now.
It's total complacency. When everyone is this bullish and nobody is hedged, it only takes one small shock to start a massive deleveraging event.
So, everyone is just assuming the market only goes up forever?
Pretty much. And historically, that's exactly when the rug gets pulled. The market is exhausted, and there aren't many buyers left to push it higher.
We're already seeing the rotation. Money is leaving the high-flying tech names and hiding in defensive sectors.
Gold has already hit new all-time highs, and now the miners, the GDX and GDXJ, are finally breaking out of a 2-year base.
Wait, gold miners? I thought they were basically dead money for years.
They were. But Chris says that's exactly why this is significant. It's a huge base break. When miners start outperforming the metal, it's a massive signal that the market is getting defensive.
Another red flag is that energy and uranium are the only things still holding up the market alongside tech.
He calls them the last man standing. Usually, energy is the last sector to peak before a major economic slowdown.
So, if the oil and power stocks are the only ones left at the party, it's time to find the coat rack?
Exactly. Once the energy sector rolls over, there's nothing left to support the indices.
Vermeulen's math is pretty straightforward. He looks at the height of the top and projects it downward.
That gives him a target of 4,000 on the S&P. It's not just a guess. It's a technical calculation based on a failed rally attempt.
If it hits 4,000, how long are we staying there?
He thinks it's the beginning of a longer reset. We might see a bounce, but the trend would be firmly downward for a while.
While the S&P falls, he expects silver to finally break its 3.5-year base.
Silver has been a laggard, but if it clears $26, it's off to the races. He sees it as a huge opportunity for the next year or two.
So the poor man's gold might actually be the winner here.
Potentially. It usually moves faster than gold once it finally gets going.
The key level to watch right now is 5,050 on the S&P. If we close below that, the stage 4 breakdown is officially underway.
And on the flip side, keep an eye on the GDX. If miners keep climbing while the rest of the market stalls, it's time to shift into protection mode.
So the takeaway is, don't get greedy with the Nvidias of the world right now.
Pretty much. Chris is saying the risk to reward for chasing tech is terrible. It's better to be early to the gold breakout than late to the tech exit.
Preserving your cash so you can buy the bottom of that 24% drop is the real play here.
Andy Schectman is back, and he is looking way past the daily price fluctuations of gold and silver to the actual plumbing of the global financial system.
He is the president of Miles Franklin, and he has been tracking a massive shift in how central banks are treating gold lately.
Is this the gold is going to the moon talk again, or is there something actually different this time?
It is different. He is arguing that the floor for these metals is being raised by the very people who used to suppress it.
Andy's central thesis is that we are witnessing a fundamental re-rating of gold.
Right. Specifically under the Basel III regulations, gold went from a Tier 3 asset, where it was valued at 50% for capital requirements, to a Tier 1 asset.
Wait, so it is now officially as good as cash, or government bonds on a bank's balance sheet.
Exactly. It is considered a zero-risk asset now. That changes the incentive for every major bank on the planet to own it.
The numbers Schectman brings up are staggering. Central banks have been buying more gold in the last 2 years than at any point in the last 55 years.
They bought over 1,000 metric tons in back-to-back years. They are dumping U.S. treasuries to fund it.
So, the people who print the money are trading their own paper for gold. That is a huge red flag, isn't it?
And he thinks gold is the bridge for that trade. It is the only neutral asset everyone trusts.
Over on the silver side, the physical stock is being hollowed out. Schectman says we have seen hundreds of millions of ounces leave the major exchanges.
If the silver is gone, who is taking it?
Industrial users and family offices. They aren't trading paper contracts. They are taking the metal home. Andy is looking for silver to finally shatter that ceiling. It broke $23.50, and now the big levels are 26 and 30.
He expects a massive short squeeze because the amount of paper silver traded is orders of magnitude larger than the physical metal available.
His big prediction is a systemic reset. He thinks we are heading toward a world where commodities are settled in something other than dollars.
So gold goes back to being the actual global currency?
Maybe not for buying coffee, but for countries buying oil and gas from each other? Absolutely.
The takeaway from Schectman is clear. If you don't hold the physical metal, you don't own the insurance.
So my gold ETF isn't going to save me if the COMEX drains to zero.
In a real squeeze, those paper contracts might just be settled in cash, which defeats the whole purpose of owning gold as a hedge.
Keep an eye on who is buying U.S. debt. If central banks keep walking away, gold's rise is just getting started.
Exactly. When the world stops wanting the debt, they start wanting the gold. That is the bottom line.
Andy Schectman's thesis is big picture. Central banks have moved gold to a different class under Basel III, and that changes everything.
Right. He points out central banks bought over 1,000 metric tons in consecutive years and treated gold like a zero-risk asset, so demand dynamics are structural.
Wait, so this isn't just another run-up? He's saying the plumbing of the system literally favors gold now?
Exactly. Schectman argues that when the people who backstop the system prefer metal to paper, the floor under prices gets lifted.
Chris Vermeulen's call is technical and immediate. He's reading a stage 3 top that measures into a stage 4 breakdown.
His measured move gives a 24% decline, taking the S&P down to roughly 4,000, and he says a close below 5,050 confirms it.
Hold on, 24%? So he's saying the market's topping pattern alone could shove us into a big bear?
Yep. Vermeulen stresses complacency indicators like the VIX and put-call ratios being depressed, so downside can accelerate fast.
Rick Rule frames the story through real rates and the country's enormous debt load. He sees gold as the defensive policy against the math.
He points out that nominal yields minus inflation gives you the real rate, and with huge public and unfunded liabilities, higher rates are toxic to solvency.
So, is gold his go-to because governments will try to inflate away debt?
Exactly. Rick says gold is insurance, but warns it can get sold in messy credit events before a policy response lifts it again.
George Gammon's core point is different. He warns the dollar is crashing up, appreciating so fast it destroys trading partners and triggers global stress.
He links interest rate differentials, commodity shocks like oil, toward $120 a barrel, and policy moves to a sudden rise in dollar demand.
Hang on, does that mean the pain starts overseas first, and boomerangs back here?
That's the thesis. When your customers collapse because they can't afford imports, your export base implodes and the shock travels home. Despite different lenses, Andy, Chris, and Rick all converge. Metals, especially gold, matter as a hedge in the current regime.
Andy frames it as central banks repricing gold. Chris sees gold and miners outperforming as money rotates to defense. And Rick calls it the ultimate insurance against debt and real rates.
So 3 different roads, same destination. Gold acts as the crisis play.
Yes. Their shared reasoning is risk reallocation. Whether from policy, technical panic, or solvency concerns, demand shifts into metal.
Both Andy and Chris call out silver as a breakout candidate. Andy noted key levels, and Chris expects the 3.5-year base to resolve.
Andy highlighted that silver already pierced 2350 and has major levels at 26 and 30, while Chris expects a clear run once 26 is breached.
So, if silver clears $26, that could be the fuel for a big move.
Exactly. Both point to physical tightness and technical momentum as the shared runway for upside.
Chris and Rick line up on mining stocks. Miners are flashing strength and are primed to outperform the metal in phase transitions.
Chris sees GDX and GDXJ breaking out of long bases, and Rick expects majors to pay sizable premiums. He even forecasts 50% premiums for top juniors in M&A activity.
So miners rally first, and deal flow follows. Got it. That sounds like an actionable pattern for investors.
Yes, the shared reasoning is structural undervaluation of producers, plus capital scarcity for new projects, which attracts acquirers.
Here's the core split. Everyone agrees something breaks, but they disagree on what actually triggers it.
Chris says it's a technical equity cycle, stage 3 topping, that measures down into a 24% stage 4 collapse to around 4,000 on the S&P.
By contrast, George argues the real shock is the dollar crashing up, an external currency shock that takes out foreign demand and then boomerangs back to the US.
Wait, so Chris is blaming market internals and sentiment, and George is blaming macro currency flows. Those are very different playbooks.
Rick and Andy add a third layer. Rick stresses solvency and real rates from huge US debt, forcing policy responses, while Andy points to a structural re-rating of gold driven by central bank balance sheet decisions. Each implies different timing and policy reactions.
So the disagreement matters because it changes what data you watch. Chart breaks, dollar flows, or debt and central bank buying.
Another real tension is how gold behaves in the messy middle of a crash. Do you get instant flight or forced selling first?
Andy is emphatic. Central banks are accumulating and the physical market is tight. So owning metal is the insurance you need right away.
But Rick warned that in a credit squeeze, margin clerks might sell gold for liquidity before policy steps in, so there could be an initial sell-off.
Chris falls somewhere in between. He sees gold and miners running as the market rotates defensive. But he also recognizes that short-term dynamics can be chaotic around a technical breakdown.
So is the takeaway to hold physical and keep dry powder, because gold could get sold, then surge?
Yes, that's the tension. Andy and Rick both want physical, but Rick explicitly warns about a two-leg event where gold is messy first and policy makes it explosive second. We just compared 4 big takes, different drivers, one clear payoff. Stay informed.
If you found the contrast useful, hit like and subscribe so you catch the next expert showdown.
This saved me hours of reading. I'm sharing it with my crew and subscribing right now.
Thanks for watching. Drop a comment on which thesis you trust most, and we'll dig into it next time.